Hello, friends. Welcome to Nirmal. Today, we're going to focus our conversation on the real estate sector, a sector which is a large employment provider. Also, the sector has been facing headwinds primarily over the last few months due to interest rate hikes. But we have been seeing a lot of launches, also a lot of traction from the sort of first-time buyers. Also, from the budget, we actually have seen a sort of thrust on the new income tax slabs, and there actually we don't have any sort of housing deduction. We have a couple of sort of questions which we really need answers to really gauge how the sector is moving forward from here. And to talk about all of that, let me today welcome our expert, Mr. Gulam Zia, a real estate veteran, Senior Executive Director of Knight Frank India. Mr. Zia, welcome to the show.
Thank you so much, Piyush. It's always been a pleasure to interact with you. I'm sure our discussion will be very insightful for your audience. Thank you for calling me. Over to you, Piyush.
Absolutely, sir. Always has been like that. Let's first take a top view on the sector here. We have seen a lot of launches in the last year. I was actually going through a couple of reports. The value basically has impacted somewhere around 5 lakh crores, 5.5 lakh crores. So there has been a lot of launches. Also shows that a lot of projects were getting completed. Also shows a lot of confidence coming from the developers that the inherent demand from the market is picking up post COVID era. And we actually saw more than 3 lakh crores of supply getting absorbed. So on the ground, how's the demand looking to you? And is this demand uniform across markets, or you're seeing some difference in terms of traction across Tier 1, Tier 2, Tier 3 cities?
That's pretty much in one question. You've tried to address the whole industry. Let me see how I can put my thoughts together on such a wide scope that you have put in front of me. In terms of demand, you are absolutely right. The supplies that have been infused was essentially because the developer did get a lot of confidence over the year ending December. We did see huge amount of transactions, actually the best in the last 10 years. The kind of transactions that we saw all across the top 7, 8 cities for sure. It was deep rooted. It happened in tier 2, tier 3 cities as well. However, focusing on the top 7, 8 cities where most of your listed players would be operating, the markets were looking very, 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 very exciting. And that obviously played on to the mindsets of the developers, because the launches that we saw all over were because they were getting confidence, that they were getting buyers knocking their doors, queuing outside, has started all over again. So that is what the comfort was. And the numbers that you're talking about, huge inventories, haven't really dampened the spirits from the price point expectations either, which means that the buyers are, while cost conscious or are not yet taking big price rises yet. However, the excitement continues. And as you rightly said, on the other side, the housing interest rate hikes, also almost about 4 or 5 consecutive hikes in last 1 year, haven't also dampened the spirits. So last quarter, I would say, from the festive season, October, Diwali, Dasara types, all the way towards the end of the year, December end, there have been some discussions in hushed up tones about whether the market will be able to absorb the interest rate hikes, etc. But to our surprise, the buyers did take it in their stride, which means that the consumption continued unabashed, unabated. And that is what has been the summation of how the year was. The closure of last calendar year, 2022, was very, very positive. And even in the month of January, as we've been observing, there has been no let up. There has been no slowing down of the industry. And while you spoke about the budget impact as well, budget, typically the developers expect a lot out of these budgets. They always prepare a huge wish list. And at the end of the day, most of them are disappointed because the government is not focusing so much on the developer lobby alone. It is focusing on more from the consumer side, job creation, etc. Of course, you would say that not much of a respite was given even to the buyers from the buyer side either. But that said, the market that we are talking about, which, since we're talking listed players, the market that they cater to is not so much into affordable and EWS kind of housing. And the government initiatives have come under Pradhan Mantri Awas Yojana in the last finance bill. And that is where huge impact, some 75,000 odd crore is what has been set aside under PMA. And that is going more towards mid to low end of the housing, where most of the listed players are not so active. Of course, there are a handful of them who are catering to affordable housing as well, and they are very happy with the budget interventions. But that said, the macro picture, in spite of whatever is happening out there, remains positive. And that is the first part to answer your question. That's my summation, that the excitement is pretty democratic, if you can use that word, all across. It is not restricted to tier 1 cities alone. We are watching this even in the tier B or the grade B or tier 2 cities, the likes of the Indores, the Bhopals, the Jaipurs, the Mysore, and so on and so forth. We continue to see action in those cities as well. The transaction numbers are not slowing down. So, in a nutshell, the industry is on a very positive note as far as residential real estate is concerned. Over to you, Piyush.
Okay, and now let's sort of slowly build upon on this first one. What's the real story here? Are we talking about the volume growth or the value growth?
Well, if you are referring to price rise by way of value growth, let me tell you, it's not happening. It's not happening because simply the velocity of sales, the rate at which the transactions are happening, is is not very. I would say that the buyers are not very comfortable with huge price rises yet. Of course, on the other side, we do see good number of traction even in the upper end of the market, which is the luxury and uber luxury projects have also started selling in places like Mumbai and Delhi, largely Mumbai. But impact of that on price rise, I would say, is not reflecting yet. On an average, we do see about 7 to 9% price rise in last calendar year. But that price rise is, if you look at the inflation also, is barely about 150 odd bips more than the inflation. And that is not something which I would call as a very serious price rise. Because and let's look at the way the price rise has been. While the listed players, the reputed developers where the conviction exists, have been able to push the prices up in the lower of the double digits, say 10-12% odd. But for every such projects, there are numerous other projects where the price rise has not been that healthy. And also, let's also look at inventory which existed, and aged inventory, old inventory, which was in the market for quite some time. And there has been a distress in that segment of the market. So, in fact, you would, on one side, where you would see 10-12% of price rise from the reputed developers, on the other side, wherever the inventory pressures are on the seller, the prices have been actually even correcting. There are discounts available. So net net, that 5 to 7% of price rise we are talking about is on account of a sizable chunk of inventory which is available for a good discount also. So if just to conclude on your question, Piyush, the price rise is not something which is alarming yet. Why would I call price rise alarming? Because when the we have seen it in earlier cycles, where the prices start jumping up 10-12% per annum on an average, then there is some amount of worry for most of us, because soon, if it continues unabated, soon you will reach a place or a position where affordability will be under question. And here comes a discussion on affordability quickly. Affordability is, and we have a certain index that we create ourselves, a Knight Frank index, which is how much of money you can set aside to pay your AMIs compared to your household income. That ratio is what we have been watching. And barring Mumbai, everywhere else you are around 25 to 23 25 to 30% max. And in a few cities like say Ahmedabad and Hyderabad, you are actually on the lower end of it, 20%. Ahmedabad has been about 20%, which means you have the ability of pay 5x of your, which is what typically we see, that your monthly, your average household income into 5 is what you can afford. So you are actually affordability has been in place for last couple of years. It's only Mumbai where it is closer to 40, 37, 40% and inching closer to 50%. But mind you, about 12, 13 years back, in Mumbai, it was 96%. So it actually climbed down from upper end of 90s to below 50 in last 2, 3 years, which means affordability in Mumbai also shot up. However, last 2, 3 months, or sorry, last 2, 3 quarters after the interest rate hikes, etc., the affordability is under question. And developers are aware after almost about half a decade, if not more, especially in markets like Delhi, where it was a gap of a year, of a decade, where the downslide was continuously happening. After a long time, developer got to see some good traction. So they are not in a tearing hurry to turn the tide around. They are also
Right.
aware about the affordability. So price rise, just to conclude, Piyush, price rise has not been so alarming yet, and we don't expect it to be anything to worry about even for the coming year. Over to you, Piyush.
Right, and with that, actually, I go to the southern geography, and I was looking at the numbers here. We saw some very strong 40% growth in the sales in December quarter in Hyderabad. You already again basically alluded that to affordability also. We also saw some strong growth in Kolkata region. We saw good growth in the MMR region. Decent growth basically happening in Ahmedabad also. But we saw some sort of drop in Chennai, and I'm trying to cover south here. I'm trying to understand what's happening in that region. Um, what's happening, sir, in the south? Is it like some sort of divergence, some particular reason, high inventory? What's your observation?
Well, once again, this is the numbers that you're looking at, especially since we're talking about southern market. While Hyderabad has been a super performer, where the transaction essentially due to affordabilities were continued to happen. Let's also look at job creation. In fact, in last calendar year, we did see huge attraction in office market in Hyderabad. In fact, Hyderabad was almost about challenging Bangalore. Bangalore with about 14 odd million square feet of absorption. Hyderabad was close on the heels, 10 plus odd million 10 plus million square feet of absorption in that city, which directly means job creation. Whereas Chennai has not been so lucky. And of course, what numbers I'm talking about were, say, the average number throughout the year. Towards the fag end of the year, because of the job losses globally and also reflections of that in India, the situation was slightly worrisome. However, since we're talking about the year-long number, Chennai has not been compared to Bangalore and Delhi, could not create so many jobs. And that's a direct reflection. I won't actually look at the correction or a reduction in number with so much of a worry because it's nominal. So I would say they have continued. Chennai has not been that bad, but it's Bangalore and especially Hyderabad that have performed superlatively well. So that is in a nutshell, that's where the situation is nothing to worry about as long as we are looking at Chennai in isolation.
Right, sir. So that basically implies that Bangalore, Hyderabad, a bit of Mumbai, again, these actually remain the very bright spots here. Also, want to take your view in terms of leasing portfolios. The rental yield basically has actually performed nicely. You also talked about a lot of pickup has been seen post COVID. What's your sort of takeaway in terms of how the rental yield is performing? Is that also contributing to sort of large sort of pickup in volumes?
I assume we are shifting base from residential to commercial because
Yes,
when you talk
yes,
about rental yield, residential is obviously not an asset class where you would ever talk about rental yield.
yes.
So that's a shift to the asset class. Office is what we are now discussing. And as I had a few inputs in my previous submission when I was talking about job creation and residential impact on residential market thereof, I did speak about it, albeit in a very superficial manner. Now, talking about offices as a focus asset class, the year was fairly good. Post COVID, we almost bounced back and landed up pretty close to the performance that we saw pre-COVID. Pre-COVID was a bumper year in the history of the country. We never saw 60 plus million square feet of office absorption. That was the year immediately before COVID. After COVID, there was a huge concern because work from home and the stuff like that became a norm of the day. But in last year, 2022, we did see good amount of traction in office as an asset class as well, which is 50 plus million square feet absorbed in that year, which was once again the best. If you ignore the pre-COVID year, this was the best. So historically, it is number two year in terms of space absorbed in a year. And that was the reason why, coming back to your point that you are raising, Piyush, that the rental yields, etc., were strengthening, which is true because rents were going up. New commitments, a large office space. I wouldn't call them campuses yet, but large office absorptions, etc., were happening, and that is in markets like Bangalore, the rents actually started strengthening. Even in Mumbai, it was shooting up a bit. And that was a clear indicator that the markets had started turning more towards the developer side, which was essentially earlier during and post COVID, it was more of a occupier driven market, had started shifting to the other end. But came this entire job losses and job cuts in especially tech sector, and that is something which is a point which we'll have to discuss 23 onwards. But if I stop my discussion on year 2022, the the overall market for office also was performing fabulously well. In fact, as we say, that was the year 2022, where residential was performing very well, perhaps the best in 10 years. Office sector was performing very well. Retail was also performing very well. So that was one year. It was an outlier historically, where pretty much every asset class was performing. So we have seen in previous upsides when the industry was looking good, one of the sector was looking good. Residential 10 years back was looking good, but office was not so good because it was still nursing its wounds after GFC. And then I would say 4 5 years, when the office sector was on a super upward trend, residential was absolutely lagging behind. But 2022 was an exception where both sectors performed superlatively well. In fact, even retail, but the discussion was not into retail yet, so I would stop short of discussing that. So, office sector, coming back to your question and trying to conclude, Piyush, performed very well in year 2022, which reflected on rent increases, which reflected on healthy rental yield as well. Of course, the budget, there have been some concerns with the finance bill and the performance of REITs after one or two of the interventions that were brought in. But that's something we can discuss in the later part, Piyush, because that's going from budget and forward is where it will come up. So if you're talking history, the year 2022 was fabulous for all kind of asset classes. Over to you, Piyush.
Right, and let me take a small insight into how the 2023 is looking back to you for the commercial. And I'm just drawing upon one insight while you were speaking on it, that it has been very strong last year. And now, basically, after some job losses, there can be some concern. So, are we expecting some sort of moderation in Bangalore, Hyderabad, the major circles where the commercial property is very strong? In fact, we heard from Prestige also that they are actually doing a strong leasing momentum over the next 2 years in Bombay also, like Mumbai, MMR region. So, what's your takeaway for 2023?
Well, as I said, the the situation is not as upbeat as it was in 2022. Concerns are rising, because as we speak, every week we are looking at job cuts happening from one company to the other. And these are not talking about the global job cuts, I'm talking about the reflections thereof on Indian markets as well. And these are a major cause of concern for the office space developers or office space owners or REITs, etc. So that is actually where it is starting. 2023 has been, the start of 23 has been pretty, I won't call it somber, but worrisome. Because the way the construction activities had picked up in 2022, The space that will come up in 2023, I'm talking about new infusion of office spaces in this calendar year. There is already a concern from the developers or those who are keen to lease those assets. It's already a concern, which will obviously reflect on the rentals as well. Well, for all these discussions, there is that optimism also that Indian economy is not that greatly affected by what's happening in all over the world. And that's one argument which is giving most of these developers, or at least it's the ray of hope which is holding them back. That after all, India may not face the kind of headwinds that the rest of the world has been facing. And basis that, I still don't see the the office space completions affected so much. Developers are, as I said, still, while not bullish, they are still okay to complete the office stocks that they were constructing. So net net, the year remains worrisome, but there have been some hopes which are counterbalancing those worries. Over to you, Piyush.
Okay, and let's shift the discussion to retail also. Like, how's that part of the market looking to you?
Well, retail did go through a serious churn post COVID because the worst affected were hospitality and retail after COVID. While hospitality bounced back, and how in the post COVID era with economy going up and the tourisms etc. shooting up. So all from the business traveler to the tourist, it all bounced back and with a vengeance. Retail also, in the meanwhile, performed very well. Now, when we talk about that, let's also look at the overall situation of the retail. About 250 to 70 odd malls existed during COVID period, before COVID period, and during COVID, about 50 odd malls fell by the wayside, stopped working, shut down. So what then we were looking at is about 220 to 25 kind of malls that remained, of which about 20, about 2 dozen, 20, 20, 25 odd malls have been super performers. In every city, you will see two, three of such malls which are outliers, are great places to hang around or to consume or buy stuff, etc. The, the second tier of malls, as I said, one of them, 50 to 55 odd malls have already shut down, were the C grade malls. Now, the B grade malls have to actually pull up their socks and prove their mettle by way of remaining in business, unlike the ones which have fallen out. So there is a struggle for that level of malls. However, meanwhile, the consumption has bounced back. As I said, like hospitality, people are back in the malls with vengeance. You see huge interest in especially F&B and family entertainment, FECs, etc. The theaters are yet to recover because of various reasons, whether it is lack of content or whatever. But that's one side which is still not showing great results. But rest of it, as far as consumption is concerned, malls are back in action. and and that is not showing, like, this consumption is not any reflection of reduction in e-commerce has also grown. Well, e-commerce hasn't grown at the rate it was growing during COVID, because those were the days when everything was completely dependent upon e-commerce. But while e-commerce has been not growing at that pace, it also grew. But retail, the spectacular growth of retail story is worth talking about. Pretty much every mall has bounced back. The occupancies in the malls by retailers are shooting up. And as we speak, the rentals have started notching up, are inching up. So overall, just to conclude, retail has seen a bounce back after the COVID, and year 22 was a great year for retails and especially malls. On the other side, when we talk about retail, organized retail, we also have high streets. High streets have also bounced back. So overall, retail has been rewriting the history of what it was about 10, 12 odd years. Even retail had a huge downtime for almost about 7, 8 years. But last year did see give a new lease of life to retail sector as well. And where we are expecting good number of new malls to be added. Almost about 17, 18 new malls are coming up in the top 7, 8 cities. And when we talk about the numbers I gave, 250 to 70 odd malls were the top 8 cities, the action is pretty good in tier 2 and tier 3 cities as well. Well, these are cities where you don't have a scope for more than 2 malls or 3 maximum. Once
Yeah.
again, in those three, one would be performing, one would be just struggling, and one would be on the verge of closure. But then I would talk about another 100 odd malls in tier 2, tier 3 cities, of which at least 20, 25 would be doing a decent business. So overall, retail has staged a very strong comeback in last 1 year. Back to you, Piyush.
Right, sir. And last two short questions, and one question will be any sort of concern you have seen from the perspective of how the budget is laying its path for the next few years. The government seems to be putting its focus on the new income tax slab. We like there has been a lot of chat again we actually have done whether it's related to any sort of is going to affect the housing loan and that associated residential demand, or you think that that part of the young market is not related to the housing, it is more about the sort of mid-age market. Any sort of concern which you think was being seen in the industry from that?
Well, the impact is not yet reflecting in the markets of what has happened post budget. We are also watching, we are also collecting numbers from the HFCs, from home loan, from the lender side. And pretty much every lender is doing well. I'm talking about post budget. The impact is slow, I'm sure, because those who had made up their minds may not suddenly change with some changes in the budget proposed in the finance bill.
Of course.
So for that impact to be seen, you'll have to wait for at least a quarter or two more. But in the interim, the environment continues to be upbeat. The numbers are not. In fact, the mid to low end of the market, whether it is in top 2, 3 cities or the rest of the cities, has been upbeat because those income tax rate changes, etc., have also left some monies in the hands of mid to low end consumers, and that the very very optimistic side of real estate developers want to believe that that money will be channelized into real estate. Well, time will tell, but the impact, no negative impact have we seen yet. As I said, we will have to wait and watch as to what exactly will be the impact on the
Sure.
consumer psyche. For the moment, there is no let up, no let down.
Let's sum up the entire discussion and let me ask you one simple question for you. If you are looking at residential, commercial, retail, whatever has happened in 2022 is like a part of history, a stellar history. 2023, which is the segment you like to place your bet on?
Well, as an investor, at least residential is not a market where price rise will be seen. Like as an individual investor, I'm talking about you and I, Piyush. If we have to buy, we have to invest in real estate. Should you buy an apartment? I would say, please steer clear. Please keep away, because this is not an asset class which is going to give you a good return. Like price rise, the only thing for you to expect having bought that apartment is to expect that the prices will shoot up. And in my view, you have to get at least 12, 13% of a price rise per annum for next couple of years. Because in my view, if the price of the product that you have bought doesn't double up in next 5 to 6 years, then it is a waste of money. You have better ways of investing, other asset classes, whether even mutual funds, etc., give you much healthier returns. So real estate is definitely not an asset class which, as a residential thing for end users, I would not, or small investors, I would not recommend you investing in it. On the other side, when you're looking at it from the large investment perspective, a few of these top developers are performing well. And this is where I believe your audience would be more aware than I am. The big developers, the good developers are going to show good performances in next 2, 3 years with the kind of consumption improving. My only worry is that they continue to remain rational on their price rises. If they go crazy, they go bonkers on price rise, then once again it can fall apart. So, assuming that the price rise shall remain under check, I am expecting the investments in the stocks of real estate would not be a bad idea. But buying an apartment, I would steer clear. I would keep away from it. Now, office is another asset class where, well, whether it is office or small shops, etc., as an end user, if you have to, or a small investor, if you have to buy a shop or something, nothing to worry about because, as I said, retail continues to grow. So your rental return of 7, 8%, 9% on a shop if you have bought will be a short, nothing to worry about on that front. But when it comes to organized investment, and here is the REIT story yet has to open up or clear up because after the budgetary interventions, we were expecting at least for two of the three REITs, there was a negative impact because of the accounting norms and standards, etc., that they have brought about. So, REITs, I would still watch out. I would not jump on that straight away. I would need a clarity of how they have been lobbying with the finance ministry to bring in a few of those clarities to let REITs also survive or do or do well. We are expecting a few more REITs waiting on the fringe to come up, and because only three REITs in the market yet is not very healthy sign. I would want this to grow and multiple options have to come up. But the way things are right now, I don't think they are going to be very keen in next quarter or two to try their lucks out in the market. So in that arena also, I would say as an end user, if you're buying a small shop or an office, you have, of course, for an office in good cities, you need a deep pocket, nothing less than 5, 6 crore, even a small office space, office unit you're looking at buying, you need deep pockets. So if you have those deep pockets, it is a good asset class to buy because your rental yields are not going to be affected yet. Because as we said, as we spoke about a short while back, the conviction in the growth of the country's economy is strong. So there could be a small worry period, quarter or two of a period to worry about, but then beyond that, not much because the long-term story is pretty intact as far as Indian economy and the growth and the GDP growth is concerned. So office as an asset class, I would definitely bet as a buyer myself. REITs, I would wait. So this is my two bit on if I have to put my money somewhere. This is how I would do.
Sure. So that's a quite detailed answer for our viewers. Again, that also implies basically sort of real estate stocks, the top branded, as again Mr. Zia was saying. But there is an area if again you're taking interest in the real estate sector versus the REITs also. Geographically, also the numbers are saying again basically that Hyderabad, Bengaluru, again Ahmedabad, those regions are doing well as we were just discussing with Mr. Zia. And many of these top companies actually are backed by very strong private equity. So geography, top brands, and then also basically from the perspective of very high pedigree is sort of the way to go to look at the sector. 2020 is looking good, as Mr. Zia is pointing about, and that basically sums up our entire discussion today. Mr. Zia, thanks a lot for showing patience. It was a long discussion, but we tried to cover everything. Thanks for coming on the show.
It's always a pleasure. Thank you so much for inviting me, Piyush. Thanks a lot.
Thank you. And with that, it's a wrap on the show.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.